Hello guys, happy new year. Hope you had a wonderful time with your families and friends during the year end, and also I believe that you all have celebrated the new year in a grand fashion. So after a long time I am coming back to you, and today this is my first video for the year 2026. Now today I thought of discussing one chapter from costing. As a cost accountant, I thought of let's cover one chapter from costing. So that's why I've taken the chapter of marginal costing, which I'm going to discuss with you today. It's a long chapter. It has got so many contents and so many things to discuss, and which is not sufficient to cover in one video, especially the length of video which I generally prepare, considering the average range of focus a person has. Based on that, I generally prepare this video. So my videos is not going to be longer. It will be about 7 to 8 minutes. I'm just going to cover the basic aspects of marginal costings and its various areas and how it is helping the business to take some profitable and successful decisions. So now today, so let us start the proceedings for this year. Happy New Year to all of you, to your families and friends, wherever you are. Stay happy, stay safe, and stay blessed. God bless all of you. This is from my side. So let's start the concept of marginal costing. So what is marginal cost? Marginal cost means cost of producing additional unit of material. Okay, so when we say additional unit of material, it means it will help the business to understand whether it is going to manufacture in its own house or it is going to outsource its production to some other parties. So now the marginal cost, if anybody asks you to describe what is marginal cost in simple sentence, you can say that marginal cost means cost of producing additional unit. Okay, so that is the thing. Now what does it covers? What does it mean? So in order to determine the marginal cost, we have to understand certain things. First we have to determine the sales. What is the sales for a particular product, sales value for a particular product. Then we have to reduce the sales from the we have to reduce the value of sales by variable cost that we incur. Now we have to categorize the cost for that matter into two parts. One is fixed cost and the other one is variable cost. Fixed cost means cost which remains fixed irrespective of the changes in the activity level. And now what is variable cost? Variable cost means cost which changes with respect to the changes in the activity level. So for example, if a variable cost for a particular product is 2 per unit, and if we produce 30,000 units of material, then the cost comes to 60,000. Now if we produce this 40,000 units of material, then the variable cost will go to 80,000. So that's how it changes. 30,000, 40,000 means activity level. Now the fixed cost means, as I said, cost which remains fixed irrespective of the changes in the activity level. So that is the concept of fixed cost. Say for example, if you have taken a space on rent. The rent for that space is 10,000. Now whether you produce 30,000 or 40,000 or 1 lakh, it doesn't matter. You have to pay the same rent, 10,000. Okay, as long as you are utilizing that particular space, you have to pay the same rent. The moment you shift your manufacturing facility to somewhere else, then that agreement is closed, then that is done. So from that point of view, nothing remains fixed in the long run. So that's a separate story altogether. So let us first, coming back to the point, we have to determine the sales, as I said. Then you have to reduce the sales by variable cost. So if your sales is 10 and your variable cost is rupees 6, the difference between sales and variable cost known as contribution. It's a very important part of marginal costing. You have to determine the contribution. Then from the contribution, you have to reduce the amount of fixed cost, and then you will have come to know the profit for the particular product. Okay, so that's how we determine the profit. Okay, that's the area. Now there are other areas to discuss. The first thing that comes to our mind is that if the contribution is, say for example, 10, in our example we have said that 10 is the sales and 6 is the variable cost, then the contribution comes to 4. So then we generally calculate a very important ratio called PV ratio, which means profit volume ratio. How do we calculate that PV ratio? PV ratio is calculated as contribution as a percentage of sales. So if our contribution in our example is 4 and our sales value is 10, then our PV ratio comes to 4 by 10 into 100, which means 2 by 5 into 100 means 40%. Okay, so that is our PV ratio. That's how we determine the PV ratio. Formula is contribution by sales into 100. Okay, there is another formula to determine the PV ratio, that is change in profit divided by change in sales into 100. That is also another way to calculate the profit volume ratio. See, in marginal costing is a kind of chapter where you will find same thing can be calculated in a different way. Okay, this is the one example I've given you. There are two formulas for PV ratio. One is contribution by sales into 100. That is the way you can understand you can understand the percentage of PV ratio. And there is another way to determine the PV ratio, is that change in profit divided by change in sales into 100. That is another way to determine the PV ratio. Okay, so that's the one thing. Another thing is that in the second thing is break-even point. Break-even point means, what is break-even point? Break-even point means an area, a point where your sales and profit, sales and contribution remains zero. A break-even means your sales is this and your profit, variable cost is this, difference is same. No profit, no loss zone, to be very honest. In single word, it is known as no profit, no loss zone. That is called as break-even point. You all must have gone through your costing books, where you will find that there's a diagram which has been drawn. I can't show the diagram right now because I don't have that much facility to show you and present you all the things via charts and all. But I can tell you verbally that in your costing books you will find that there's a diagram which shows how the break-even point has been calculated. It's basically a no profit, no loss zone, where it means a unit, what is the number of units that have to produce in order to stay neutral, where you will neither incur profit nor you will incur any loss. Say in our example, if our contribution is 4 and fixed cost is 4, then the profit is nil, which means that is no profit, no loss zone. So that is the break-even point. How do we calculate the break-even point? The formula to calculate the break-even point is fixed cost divided by PV ratio. That is the method of calculating the break-even point. Okay, that is the one way of calculating break-even point. The third point coming is margin of safety. Margin of safety means the extent to which the fall in demand could be absorbed by the company. After that, if the demand further falls for the particular product, then the company might start incurring losses. So that is the basic concept of margin of safety. Means, as I said, the extent to which the fall in demand could be absorbed. That is known as margin of safety. Okay. How do we calculate the margin of safety? It's the difference between sales and break-even sales. Okay. Or there is another way to calculate the margin of safety, is profit by PV ratio. That is another way to calculate the margin of safety. Okay. So that's how you can calculate the margin of safety. So I have explained to you the PV ratio, profit volume ratio, break-even sales, margin of safety, and also I have explained to you the concept of fixed cost and variable cost. So these are some of the basic ideas that I have given it to you. Considering the length of my video, it's a small video, it's a 9-minute video. Again, in the next video, I'll get into the details of each and every aspects of marginal costings. So don't worry, I'll cover other aspects of the marginal costing in detail as well. This is not the last video on marginal cost. This is just the tip of the iceberg I've just talked about. There are so many other permutations and combinations. Even I'll cover some of the practical examples which is generally asked during the examinations of your higher secondary or in the graduation level. Okay, so I'll cover that aspect also. So for the time being, you can just go through my videos. You will get an understanding of what is fixed cost, what is variable cost, what is marginal cost, how do we calculate contribution, what is PV ratio, what is margin of safety, what is break-even sales, how do we what are the various ways by which we can calculate the contribution. So another point I would like to discuss here, another way to calculate the contribution is that fixed cost plus profit. That is also in the back calculation manner. If you do, you will find the value of contribution. Okay, so that's all for today. Goodbye. Happy New Year again to all of you. In the next video, I'll cover some of the more aspect. Thank you so much. Good night. Have a nice dream. See you again. Bye bye.